Joining us now from super safe haven, Zurich, Switzerland, is Marc Faber. He is the editor and publisher of the Gloom, Boom, and Doom Report. He accurately called the crash in '87, the tech downturn in 2000, the market bottom in 2009, which is why we love, one of the many reasons we love to have him on.
Thank you.
Marc, let me ask you first about the bubble in treasuries. I mean, we've all watched in amazement as the 10-year yield dropped down below 2% yesterday. What happens, though, to pop that bubble? What needs to happen for it to burst?
Well, actually, it may not burst for a while because obviously the Fed will keep short-term rates at close to zero for an extended period of time, and likely there will be some either official or unofficial type of QE3 and QE4. But in my view, an investor who today buys a 10-year treasury with this kind of a yield, it's today at 2.08%, is not going to make any money in the next 10 years, either because yields will go much higher or because the dollar will go much lower.
Let me ask you, and I think you'd say it's a different story with gold. You see people obviously piling now for safety into the Swiss franc, into U.S. treasuries, into gold. But whereas a bubble bursting or a turnaround of the trade could bring the franc down and treasuries down, you probably don't think that's the case with gold. Why is it different than these other safe havens?
I think that gold has had a bit of a run-up here that is above the trend line, and that the correction can occur. But I don't see a huge downside risk in gold, because if you think it through and people are concerned about cash, they're concerned about sovereign debt, they're concerned about everything, and the stock market has given a very powerful sell signal. I think that as soon as the gold price would drop, say $100, $150, there'll be a lot of physical buying.
Is the Swiss franc as good as gold, Marc? I mean, do you see the same...
No, I don't think that the Swiss franc is as good as gold, because it's also essentially managed by a central bank, and nothing that is managed by a central bank is 100% reliable. But the Swiss franc will remain a better currency than the US dollar. Having said that, we also went down on the Swiss franc against the US dollar by 10% within just a few days.
Hey, Marc, I want to go back to your talk on treasuries. I know we talked with you, Bloomberg News talked to you back in December, and you said, you know, U.S. treasuries, they're suicidal. And yet treasuries, fixed income securities from both the U.S. and Europe, they've been having the best returns, monthly returns since 2008. You say yields are going to go higher. When do they go higher? Or could we still get some decent gains out of treasuries for some time, considering everything else that's out there?
Well, I have to give credit to David Rosenberg, who argued that you should go long treasuries for the last 2 years. Mm-hmm. But at the same time, if you look at longer periods of time, say from March 2009 up to today, then obviously stocks are still significantly up. We're at above 1,100 on the S&P, and we were at 666 on March 2009. And emerging markets are still way up from the lows at that time. So I think that from a very short-term perspective, maybe treasuries are still okay, but I wouldn't buy them simply because I'm not a short-term trader.
Right.
And I look at investments, say, with a 10-year time horizon.
Right.
And in that respect, I advise diversification. In other words, I would own some bonds and cash and gold and equities and real estate. Mm-hmm. But I would rather today, if you put a gun on my head and say, Marc, you have to buy something, 10 years treasuries for the next 10 years, or equities, I would buy equities.
You would buy equities. No,
yeah, but I think they'll go lower because the market has given a very powerful sell signal. And earlier you were talking about Hewlett-Packard. Mm-hmm. I mean, Hewlett-Packard started to act badly as a stock already 3 months ago and gradually broke down, and today we have a very big sell-off. I mean, but right. It was clearly not acting well, and the entire stock market, in my opinion, traced out a very large top right. in the February to June period of this year, and we've broken down. And to make new highs above 1370 on the S&P will be incredibly difficult.
All right, we're going to have to leave it there. Hey, Mark, thank you as always. Marc Faber joining us there on the phone from Zurich.